Welcome, everyone. Today we are diving into the time price opportunity chart, often called the TPO chart. This tool is incredibly powerful for understanding market behavior and making better trading decisions. By the time we finish, you will know exactly how to read TPO charts, how to identify those key price levels, and how to use this information to make your trading decisions smarter. Stick around because we are going to break everything down step by step, and I promise it will make sense even if you are brand new to TPO charts. Have you ever wondered where the market truly finds its value during a trading session? The TPO chart, or time price opportunity chart, is your key to unlocking that understanding. Simply put, a TPO chart is a tool that shows you exactly where the price has spent the most time during a trading session, acting like a heat map that highlights where the price lingered the most. It provides a clear picture of market behavior, helping you identify crucial levels where the market has found balance or exhibited strong moves. Let's dive in and uncover how these insights can make all the difference in your trading decisions. The chart patterns on a TPO chart can reveal a lot about market sentiment and activity. You might see patterns like a balanced profile, which looks like a bell curve, indicating that the market is in balance. This means that buyers and sellers have found an agreement on price, which often leads to consolidation. Balanced profiles are usually formed during periods of low volatility, suggesting that the market is comfortable at those price levels and there is no urgency from either buyers or sellers to move away. These periods are crucial for traders who prefer range-bound strategies, as they can buy near support and sell near resistance with lower risk. On the other hand, you might see an elongated vertical profile, suggesting the market is trending either up or down, with price moving quickly through different levels without much consolidation. This kind of profile, also known as an imbalanced profile, often occurs after major news releases or events that create strong market sentiment. In such cases, the market is not interested in spending much time at each level because there is a sense of urgency. Either strong buying or selling pressure is pushing the price in one direction. Recognizing this type of profile can help traders position themselves in the direction of the trend, especially if they can identify continuation patterns or lack of resistance in the direction of movement. Another common pattern is the double distribution profile, where two distinct areas of balance form within the same session, separated by a sharp move. This can signal that the market initially found value at one level, then quickly re-evaluated and established a new area of value at a different price range. Double distribution days often indicate a strong shift in market sentiment, and the area between the two distributions can serve as a critical zone for support or resistance. Traders can use this pattern to predict whether the market will fill the gap between the distributions or continue to build value at the new level. You may also encounter P-shaped or B-shaped profiles, which indicate different types of intraday activity. A P-shaped profile often forms when there is initial selling pressure, followed by a period of accumulation where buyers step in and push the price higher. This pattern suggests that buyers eventually overcame the initial selling, and it can be a sign of potential bullish continuation. On the other hand, a B-shaped profile represents strong initial buying pressure followed by selling and distribution, indicating that sellers eventually took control. This kind of pattern is commonly seen when a market initially spikes but then fades, suggesting that the initial enthusiasm was not sustainable. Understanding these profiles helps traders make informed decisions about whether to trade breakouts or look for potential reversals based on market structure. Why does this matter? Well, seeing where the price has spent time shows you where the market sees value and where it has rejected value. the market tends to revisit levels where value was established, and these levels often act as magnets for future price movement. Additionally, rejection levels are where price quickly moved away, signaling an imbalance between buyers and sellers. Recognizing these chart patterns can help in identifying potential breakouts or trend reversals, providing clues for smart entry and exit points. That helps us figure out possible support and resistance levels, which are key to making smarter trades. Now, let us dig into how TPO charts work. The basics of the TPO chart start with something called TPO blocks. Each TPO block is typically shown as a letter or a symbol, and each of those stands for a specific time period. Most often, this period is 30 minutes long. These blocks are placed at the price level where trading occurred during that period. So if you see a lot of blocks at one price, you know that price stuck around for a while. The more blocks, the more significant that price level becomes. As the day goes on, the TPO chart builds up a price distribution. This distribution gives you an idea of where the price stayed the longest and where it moved quickly without much pause. You may notice that some areas have a dense cluster of TPO blocks, while other areas are sparse. The dense clusters represent the levels where the market spent considerable time, which often indicates value areas. Sparse areas, on the other hand, show where the price moved rapidly, often signaling strong buying or selling pressure that did not allow for much trading. Unlike other charts, TPO charts do not show trading volume. Instead, they focus on the time spent at each price level. This focus on time rather than volume makes TPO charts unique because they highlight the psychological aspect of trading specifically, where traders felt comfortable spending the most time. This kind of information is particularly useful for finding areas where the market perceives value, and where important support and resistance levels are likely to form. Additionally, chart patterns can form within the TPO distribution itself, giving more insights into market dynamics. A pattern known as the double distribution occurs when there are two distinct areas of value separated by a sharp move. This kind of pattern often suggests a shift in market sentiment, and traders can use it to predict potential continuation or reversal points. The area between the two distributions often acts as a critical zone of low trading activity, and price tends to either fill this area or react strongly to it. Double distribution profiles can be powerful indicators of a changing market environment, often linked to important news or economic events that cause a reevaluation of fair value. Another notable pattern is the P-shaped or B-shaped profile, which gives clues about intraday trends. A P-shaped profile, for example, indicates that there was initial selling pressure followed by a phase of accumulation or buying. This pattern typically forms when there is a significant downward move early in the session, but buyers come in and the market spends considerable time at higher levels, suggesting bullish sentiment. It can indicate that the market has found value after the initial sell-off and may continue to move higher. In contrast, a B-shaped profile shows initial buying followed by distribution or selling pressure. This pattern often forms when there is a strong buying impulse early on, but then selling pressure emerges, causing the price to decline and establish value at lower levels. It suggests that initial enthusiasm was not sustained, and sellers eventually gained control, signaling possible bearish continuation. Another interesting pattern to look out for is the Gaussian or normal distribution profile, which closely resembles a bell curve. This balanced profile indicates that the market is in a state of equilibrium, where buyers and sellers are equally active, leading to price consolidation. During these phases, traders who prefer range-bound strategies may find good opportunities to buy at support and sell at resistance levels. Conversely, an excess profile shows areas where price moved quickly without much trading, indicating rejection and often marking the extremes of a trend. These spikes in the TPO distribution highlight where price was pushed to an extreme but could not sustain those levels, signaling possible turning points. Another valuable pattern that traders should understand is the single print profile, also referred to as an area of price rejection. Single prints occur when price moves quickly through a level, creating minimal TPOs at that price. These areas of single prints can act as support or resistance when revisited, as they represent levels where the market showed strong directional conviction with minimal interest in establishing value. The return to a single print area can lead to a significant reaction, either confirming the previous rejection or breaking through it, thus providing critical insights for planning trades. Understanding these patterns helps in predicting the direction of the next move, which can be crucial for timing entries and exits. By carefully analyzing these different TPO formations, whether it is double distribution, P-shaped, B-shaped, balanced, or excess patterns, you gain a deeper perspective of market behavior, allowing you to align your trades with the prevailing sentiment and structure of the market. Recognizing and adapting to these patterns can significantly enhance trading strategies, reduce risks, and improve overall decision-making. TPO charts can also develop a balance or excess pattern. A balanced TPO profile, similar to a bell curve, indicates equilibrium where both buyers and sellers are agreeing on the price. In contrast, an excess pattern is characterized by a spike or thin area in the profile, showing that price moved too quickly to attract much interest, indicating a potential reversal area. Recognizing these patterns provides traders with powerful clues about whether the market is likely to continue in the same direction or potentially reverse. There are some key features on a TPO chart that you need to know to understand them fully. Let us start with something called the point of control, or POC. The POC is the price level where the most TPOs happened. Think of it as the place where the market found a fair value during that session. This level is important because the price often reacts when it returns to the POC. It might bounce off it or move through it, but it is usually not a level to ignore. Another key feature is called the value area. This is the price range where 70% of the trading activity occurred. It shows the area where the market spent most of its time finding value. The value area is important because it often acts as a magnet. Prices tend to return to this area, and it helps in identifying support and resistance levels. There is also the initial balance, which is the price range from the first hour of trading. The initial balance is a strong indicator for future moves. If the price breaks out from this range, it often means a significant movement is coming. Traders pay close attention to these breakouts to catch big moves early. Finally, there are single prints. Single prints show where the price moved very quickly, leaving a gap in the market profile. These rapid movements often occur when there is a sudden influx of buying or selling interest, leading to little to no trading activity at these levels. When you see single prints, it means that there was not a lot of trading activity at those price levels, often due to sudden and sharp moves in the market driven by significant news events, economic data releases, or strong shifts in trader sentiment. These levels are particularly significant because they indicate areas where the market was imbalanced and moved with urgency, often reflecting a strong conviction from buyers or sellers. Single print areas are critical to watch because they represent levels where the market has not yet established fair value, and when the price returns to these areas, they often act as strong support or resistance. These levels can be points of high interest as they frequently lead to notable reactions, either confirming the previous momentum or indicating that the market sentiment has changed. Often, these areas are where buyers or sellers overwhelmed the other side of the market, leading to a sharp, fast move. When the price returns to these levels, it can lead to significant interactions that tell us a lot about the current strength of market participants. Traders use these levels for potential reversals or significant reactions, as they can offer clues about whether the initial momentum will continue or if a correction is likely. For example, if a level that was previously rejected is approached again, traders will closely monitor whether there is enough strength to break through it or if it will reject once more, indicating a continuation of the previous trend. In cases where price moves through these levels decisively, it can serve as a signal that the initial imbalance has been resolved and new value is being established. Additionally, understanding how price behaves when it approaches these single print zones can provide valuable insights for trade entries, exits, and risk management. A strong rejection at a single print area, for instance, could signal a reversal, offering traders an opportunity to enter trades with tight stop losses, minimizing risk. Conversely, a breakthrough at a single print area may suggest a continuation of the trend, often leading to increased volatility and momentum. These moments are particularly powerful for breakout traders who seek to capitalize on swift price action following significant price levels. Observing the volume, candlestick formations, and general market sentiment at these single print levels can further enhance a trader's ability to make informed decisions, ensuring they align with the prevailing market dynamics. Now that we have covered what TPO charts are and how they work, let us get into how to read these charts. If you see a TPO profile that looks balanced, like a bell curve, it means the market is in balance. Buyers and sellers are in agreement, and this kind of situation often leads to consolidation. The price trades in a narrow range without any big moves up or down. On the other hand, if the profile looks more vertical, that means the market is imbalanced. The price moved quickly, and this often means the market is trending. Understanding whether the market is in balance or trending helps you decide whether you should trade breakouts or stay within the range. Now, let us talk about how you can use TPO charts to spot those key price levels. First, keep an eye on the value area, high and low. These are the boundaries of the value area, and they often act as strong support or resistance. When the price approaches these levels, it is a signal to watch closely. Will it bounce off or will it break through? The point of control is another key level to watch. Think of it as a magnet for the price because it represents the level where the most trading activity occurred, suggesting it is an area of fair value. If the price is approaching the POC, there is a good chance that it will either bounce off or pass through it, depending on the strength of the current market momentum. When the market is balanced, the price often revisits the POC multiple times, leading to potential entry and exit opportunities for traders. Additionally, a rejection at the POC can indicate that traders are unwilling to accept that price as fair value, leading to possible reversals. Traders often look for confirmation in the form of candlestick patterns, momentum indicators, or other signals when price is near the POC to decide whether to enter or exit a position. It is usually a level that plays a significant role in understanding the ongoing market sentiment, whether it leads to consolidation, rejection, or continuation of the trend. And do not forget about those single prints. These show where the price moved so fast that there was almost no trading. When the price comes back to these areas, they can be like strong barriers. They are often levels that cause the price to either reverse or break strongly. There are several strategies you can use with TPO charts. One strategy is called value area trading. In this strategy, if the price moves back into the value area from outside, there is a good chance it will move all the way through to the other side. Traders often look to buy near the value area low and sell near the value area high, expecting the market to move between these points. Another strategy is called the point of control reversion strategy. If the price is moving towards the point of control, traders expect a reaction. This could be a bounce or it could be a breakthrough. Either way, it is a great spot to watch for trading opportunities. Another popular strategy is the breakout strategy. If the price breaks out of the value area or the initial balance, it could mean that a new trend is starting. Breakouts often occur after periods of consolidation, where the market has gathered enough momentum to move decisively in one direction. These breakouts can happen on either side of the value area or the initial balance, and they indicate that the market is ready to seek a new level of value. Traders often look for confirmation that the breakout is real before making their moves. This is where other indicators can come in handy, such as volume spikes, which show strong participation during the breakout. Volume is particularly important as higher than average volume confirms that the breakout is supported by significant interest from market participants. You can also use moving averages or trend lines to confirm that the price is sustaining the move in the breakout direction. Another key aspect to consider is the price retesting the breakout level. Breakouts often involve price piercing through a resistance or support level, and a subsequent retest of that level can be highly informative. Watching for price retesting the breakout level is a good way to verify if it will hold, signaling a continuation of the trend. If the retest holds, it often provides a safer entry point for traders looking to follow the new trend. Retests can serve as opportunities for entering with reduced risk, as traders can place tight stop-loss orders just below the retest point in an upward breakout or above it in a downward breakout. Breakout trading can be especially effective during times of high volatility, when significant news or market events lead to strong directional moves. During these times, breakouts are more likely to follow through with momentum, as there is a clear driver behind the market movement. However, it is important to recognize the difference between genuine breakouts and false breakouts or fakeouts. False breakouts occur when price temporarily moves beyond a key level only to reverse and fall back into the previous range. This can lead to losses for traders who enter too early without proper confirmation. To avoid false breakouts, traders often look for multiple layers of confirmation. Alongside volume spikes, observing candlestick patterns like engulfing candles or strong closing prices beyond the breakout level can provide additional validation. Using momentum indicators, such as the Relative Strength Index RSI, can also help determine whether the breakout has the strength to continue. RSI values moving above a key level, such as 50, during an upward breakout can indicate increased buying momentum. Similarly, divergence between price movement and RSI can serve as a warning of a potential false breakout. Combining these various tools can greatly improve accuracy in identifying genuine breakouts versus false ones. Successful breakout traders typically exercise patience, waiting for a confirmed retest or sufficient evidence that the breakout is backed by strong market participation. By doing so, they can enhance their probability of capturing sustainable market trends, reduce the chances of getting caught in fakeouts, and optimize their trading entries and exits. Speaking of other indicators, combining TPO charts with other tools makes them even more powerful. For example, volume profiles can add another layer of understanding. While the TPO chart shows where the price spent time, the volume profile shows where the most volume traded. Together, these two tools can confirm key levels and help you make better decisions. Moving averages are also helpful when you are using TPO charts. For example, if the price moves above both the point of control and a moving average, it can be a strong sign that the price is going up. You can also use momentum indicators to confirm whether a breakout is strong enough to act on. These indicators give you more confidence in your trades. Here are a few practical tips for using TPO charts. First, always focus on the value area. The value area high, low, and point of control are the most important levels. Watch closely how the price interacts with these levels. You can often find great trade setups here. Second, be on the lookout for reversion opportunities. If the price moves outside the value area but comes back, it might rotate through the value area again. This type of movement often indicates that the market is not ready to establish new value outside the existing range and is instead reverting to its comfort zone. Reversion to the value area occurs when there isn't enough buying or selling pressure to sustain a breakout, and instead, the market moves back into the previously established range of value. This gives you a chance to trade within a predictable range, often allowing for low-risk entries near the value area boundaries. Pay close attention to how the price re-enters the value area. If it moves back decisively, it increases the likelihood that it will travel through the entire value range. Traders often refer to this as a rotation or a reversion to mean value, where the price oscillates between the value area high and low. Traders often use this strategy to buy at the lower end of the value area and sell at the upper end, capitalizing on the predictable oscillations within this range. Furthermore, when price enters back into the value area after being rejected at higher or lower levels, it suggests that the market participants still find that area to represent fair value. This insight allows traders to anticipate potential movement through the entire value area, increasing the probability of successful trades by targeting the opposite end of the range. Using additional confirmation tools, such as observing volume, candlestick patterns, or momentum indicators, can further improve the effectiveness of this strategy, reducing the chances of false signals and increasing confidence in trade entries. Also, keep an eye on the initial balance. Breakouts from the initial balance often lead to bigger moves, so it is important to watch price action closely around this range. It could be the beginning of a significant trend. Now let us talk about some common mistakes people make when using TPO charts. First, do not overreact to small moves. Not every price movement outside the value area or the initial balance is a big deal. Be patient. Wait for confirmation before you decide to make a trade. Second, always remember to consider the larger context. News, economic data, and overall market trends can all significantly affect how the price moves at key levels. For example, major economic announcements, such as interest rate decisions or employment data, can lead to increased volatility and may cause the price to break out of value areas or key support and resistance levels. Political events, earnings reports, and unexpected global developments can also lead to sharp price movements. Therefore, it is essential to align your TPO analysis with broader market sentiment and external factors. Always keep the bigger picture in mind when you are looking at TPO charts, as understanding the context can help you avoid false breakouts and make more informed trading decisions. And finally, do not forget to use stop losses. This is especially important when you are trading breakouts or price rejections. Always manage your risk to protect your capital if the market moves against you. If you want to get comfortable using TPO charts, the best way is to practice. Start by practicing on a demo account. This way you can learn without risking real money. Keep a journal of your trades so you can review them later. You can learn a lot by looking back at what worked and what did not. Also, experiment with different time frames. Try using daily, weekly, or even intraday TPO charts. Each time frame can offer different insights. For example, daily charts are excellent for identifying overall market structure and longer-term value areas, which can help you spot major support and resistance levels. Weekly TPO charts can be useful for understanding broader trends and getting a big picture perspective on where value has been established over longer periods. Intraday TPO charts, such as those using 30-minute or hourly intervals, are ideal for day traders who need to make quick decisions based on short-term price action and value shifts. You might find that one time frame works better for you depending on your trading style, and it is often useful to compare multiple time frames to get a clearer sense of the market dynamics and validate potential trade setups. To wrap up, remember that TPO charts give you a unique way to understand market structure by showing where the price has spent the most time. The point of control, the value area, and the initial balance are all key features that help traders spot support, resistance, and possible trades. Start by focusing on these key areas, and then combine these insights with other tools to make better decisions. Keep practicing, keep learning, and remember that mastering any trading tool takes time. The more you work with TPO charts, the more comfortable you will get, and soon it will become a valuable part of your trading routine. Do not hesitate to ask questions, share your experiences, and discuss what you have learned. Let us grow and improve together.